Hello and welcome to episode 9 of Voila Startup Talk series. This is Anjali Bawa, founder of Voila Experts. In today's episode, we will be discussing about the new storm of vendor funding and how businesses are evaluated and shall be affected this season. To discuss the same, we have Voila Expert and founder of Consultancy Ventures, Mr. Tushar Kansal. With over 20 years of experience, Tushar has supported numerous startups and growth stage companies in diverse tech and non tech sectors. To many accolades and awards to his name, such as the Best Startup Supporter by All India Council for Robotics and Automation, received from Dr. Kiran Bedi herself, awarded Business Leader of the Year in Investment Management by Asian African Chamber of Commerce and Industry in 2021, and the latest being the Entrepreneur of the Year 2022 by Business Connect magazine. A mentor, thought leader, and speaker, he aims to help change makers accelerate their dreams by means of venture capital, angel investment, and strategic services, picking up global deals while being center agnostic. A very warm welcome, sir. We look forward to a very rich conversation today.
Thank you, Anjali. Thank you, you and the entire team at Boiler Experts. And it was really nice being on your event, judging the event, and now today speaking with you. And thank you for the introduction as well. I would I would request all the viewers watching to have a look at my website consultancy.com and tusharkansal.com, and also you can search my name on Google and YouTube. You'll find around 250 videos, and can have a look at them as well.
Great, good to know. So, now tell us a little bit about yourself, about your journey, how Consultancy Ventures was born.
So I was very lucky in the sense I have been, post my MBA from Delhi University. I had a business, but I exited that business to a national player in IIT-JEE coaching, Narayana Institute, and I was having all business experience of 6 years post MBA. But I was lucky because the markets were doing very well in 2006 and seven, so I was picked up by Deloitte and Touche. I learned the financial ropes at Deloitte and Touche, and this included valuation, due diligence. This included term sheets, and all the things. And from there, I was headhunted by Brand Capital, which is the venture arm of Times of India Group. So, from a consultant side, I moved to a buy side, and I was part of the team which invested almost 100 crores across companies. From there, I worked in two treasuries. One was a 15,000 crore Aircel treasury. I was lucky again because I was in the central treasury. So the decision making of how to use that money used to happen there, how to raise money used to happen there. From there, I was head of treasury of a Russian telecom company, MTS. So I raised $3 billion for them in 3 years. So I was lucky that I learned the entire rope of finance from all the sectors, because finance is a huge field. So when I started out again after being a CFO at a company owned by Guggenheim Partners, then I wasn't conversant about the consumer business, how marketing works and how things work. So naturally, I made some errors. And then I decided that since I have been into finance, I have been properly trained into finance, so I should be working in finance only. And that is when I started Consultancy Ventures in 2016. And we have built relationships with 1,000 investors globally from India, Singapore, US, UK, and UAE. I've done more than 200 talks and webinars and events. I've been very fortunate to address the entrepreneurship cells of all the IITs and many IIMs, uh, and have been awarded as well. So it's been a wonderful journey. We basically offer a holistic service, end-to-end service, hand holding the founders and the company all the way till they raise the funds.
Amazing. That's what you need, right? You need a hand-holding support end to end. And you have been doing this for a very, very long time. So thank you for doing that. And we need so many more people collaborating here.
Thank you, Anjali.
Great. So now we know, where this kida has started. Now I want to know, like, coming to our topic of our session, what is really winter funding and how is it impacting businesses?
Anjali, you'll have to bear with me. This will call for a large answer, not a short answer, because finance is intricately linked with economics, and India is linked with global economics, and all the countries trade with each other, and the decisions in one country impact the other countries. So right now, India uh, is a ocean of calm in a globally turbulent world, because the economies abroad, like European economies, UK, uh, US, Canada, Australia, New Zealand, Japan, South Korea, all the big ones, they are not doing well. And India, because of its very good policies in the last 3 years, 4 years, is doing relatively quite well. So the whole background is, how did winter funding come? So basically, we have to understand the structure of the global economy. Uh, the Western economies, the basic products and services have all been provided. They are beyond that now. And what happens is that after a point where everything gets, the basic services needed by people uh, get are available, then uh, countries look for other ways and means to grow the GDP, because the GDP has to grow for a lot of people to get employment. So countries move from manufacturing to services, and when they move from manufacturing to services, then managing money becomes the main business rather than putting it into manufacturing or products. And so the Western governments are running on two legs, the US government specifically. One is managing money and other is technology, and the third is of course defense products, but they are mainly running on these legs. What happened was that three things brought a huge amount of growth globally. One was the striking of oil in Saudi Arabia. Second was the fall of Soviet Union in 1992, post which all the raw materials of Soviet Union, ex-Soviet Union countries are available for cheap in Europe and US and other countries. So their GDP did well. And the third was that the labor cost r- quite rose quite high in the Western countries, so they shifted their manufacturing to countries like China. So these three factors were what brought growth in Western countries. And the fourth factor is, of course, the use of Indian talent, the technology professionals. And what is happening is that, because the main business in the Western countries is making money through money, means through investing. So they can't make money through fixed deposits because the interest rates are very low, 0.25% per year, 0.5% per year. So the only way to make money is take that money for cheap, borrow that money at very cheap interest rates, and put it in different assets like commodities, oil, copper, gold. Put it in stock markets, Indian stock market, US stock market, NASDAQ, Singapore. Put it in real estate, uh, and then put it in, and the new fad is cryptocurrency. So all that huge money which Western governments have, uh, they give it for very cheap, on a very low interest rate. 50% of their economy is services driven. They borrow that money at very cheap and they keep on investing. So there are bubbles in assets. In all the assets, there are bubbles because so much money is flowing from these developed countries. And especially Euro, USD, and the Japanese yen. These are called carry trade currencies. Now, the impact of their economics falls over to the entire world. So sometimes, since 2008 Lehman crisis, they have been printing huge amount of dollars. The US has printed from $7 trillion to $31 trillion is the balance sheet of their Federal Reserve. $25 trillion have been printed by the US alone in the last 12 years. All that money is splashing down. Now, what happened was they created a huge amount of dollars during COVID, and they gave that money to their citizens that this is COVID time, and because so much money was available in the hands of businesses and citizens of their countries, that huge amount of money is chasing the same supply chain, the same products and services. So there was a breakage in the supply chain with Russia and Ukraine war, and in China because of the policy, the COVID policy there. There are lockdowns, and so supply chains are broken. So supply is less, availability of money is more. So the value of money falls down, the value of supply goes up. So inflation comes. So because of inflation, governments, people start complaining that everything is becoming costly. Because that happens, then the central bank of the countries have to step in, and they have to increase the interest rates so that the supply of money becomes less, and money starts getting out of speculative assets to safe returns like fixed deposits in a bank or treasury bonds, because the central banks have raised interest rates. So, because this money supply goes lopsided, it creates a problem globally, and that's the funding winter. So, basically, three things impact any markets. One is liquidity, second is growth, and the third is emotions, the sentiment. So right now, liquidity is becoming less, and the main drivers of valuations was always liquidity since the last 12, 13 years. The growth wasn't so much. So liquidity has become less, growth has become less, and so the sentiment also has become less, and that is the funding winter. And uh, so in India, when the Western governments were giving money, showering money to their citizens and corporates, the Indian government was also given advice by these countries to give money. But our government, they said, if the money we give to the people is used by the people, then it gets added to productivity, then it gets added to economy, then it gets added to GDP growth. But Indians, they always believe in tough times you save the money. So the government knew that if we give the money to our people, they will save it. It won't come out in the economy, it won't come out in GDP growth. So very wisely, they gave a very small amount, I think 2,000 to 5,000 rupees per month, to a huge number of people in their directly in their bank accounts, but majorly provided food from the government godowns to 80 crore Indians. So they provided food instead of money, so the inflation in India is less as compared to the global huge bonfire of inflation, and we are relatively calm. Our stock market hasn't fallen, it is still at 60,000. Their stock markets have fallen by 25%. Amazon used to trade at $1.9 trillion. It is at $800 billion, fallen by more than 50%. So this is what is happening. The funds sitting in India, most of them have raised money from abroad. So they are thinking that if we utilize all this firepower now, and suppose the funding winter goes on for long, then our investee companies won't have access to more money. So we should keep some more money on the sidelines. So that is where they are, and they are expecting better valuations. Valuations have fallen by 22 to 28%. So this is the exact contours of what the funding winter looks like.
Got it. So basically, we need to look at three things, which is actually affecting the entire thing is uh, liquidity, growth, and sentiment, which is very, very low right now regarding the crisis, which is not only nationally, but internationally as well. So, having
Absolutely.
said that, in India, definitely government has taken some amazing steps to ensure that we are saving and we are at least safeguarded by a lot of factors, and we are still at a better pace as compared to the other countries. But how, as an entrepreneur at one stage, especially at early to mid stage, how should we prepare for this challenging time, and how much can we expect will this last?
See, if you there was a ranking which was done of the top unicorns in India, and they were ranked according to their profitability. Like, what is their profitability? And if you look at the number one and number two companies on that rank, unicorns, Indian, they were Zoho and Zerodha. Profitable, number one and number two. They never raised investor monies. So the bottom line is, if you raise investor money, somewhere you become slack about your business model. You kind of become slack about making profits, about the unit economics. So this is a challenging time because a lot of the businesses, they uh, there's a lot of competition, so they run on losses. So they meet the needs of money by diluting the shares. But if the economics on the balance sheet side, which is dilution of shares, there is a problem in the markets, then you have to keep 12 to 18 months worth of cash burn. That much amount you have to keep in your balance sheet, and always have 12 months with you, because this funding winter, nobody can assess how long it will actually go, but it might go for more than 1 year or 1.5 years. To my mind, I think 1 year is there. So one thing is that you have to be very conscious about the unit economics. You have to be very conscious about uh, earning on every unit sold. The second thing is, have lean teams. Don't be like a Snapdeal, which recruited 10,000 people and 1 year later retrenched 8,000 people. Have lean teams so that the decision making is fast, there is low bureaucracy. Then uh, top down alignment. Have, resilient organizations require resilient leaders. So third thing is granular and flexible planning. So you do the planning in small groups so that it is faster and you are able to see the trends in the market early. Then focus on needle movers. Like, if you go to McKinsey, he might suggest that reduce the coffee cups and buy thinner grade paper. But inefficient customer acquisition cost, CAC, might be the real culprit. So focus on the needle movers. Then cutting cost and muting growth is the lazy approach. Uh, Go for growth, and which means growth on the top line 3x, 4x, while also improving unit economics. Then, as I said, cash is king. You have to keep cash worth 12 months of cash burn. And always remember, cash is greater than profit, is greater than revenue. Top line is vanity, bottom line is sanity, and cash is the reality. So break down the business into multiple P&Ls, profit and loss, and double down on the cash generating verticals while reevaluating verticals that are bleeding money. And lastly, build a robust culture which gives the highest return on investment, ROI, in crisis mode. And culture is the only sustainable competitive advantage, especially during a recession. So driving a customer focused culture will not only help businesses survive during downtime but also thrive. A small example on that: in each of your meetings, keep a seat empty next to you, next to the leader, and the seat is the customer. What is the customer thinking about this meeting, about the outcomes of this meeting? It has to be customer centric. So these are my advice to all the startups.
Some very, very profound thoughts, and very nicely put that how much, what all aspects we need to think when we are planning to optimize our cost. Bootstrapping is another way, and how important is cash. On that note, lately we have seen that even the well funded startups, like at the peak of it, who might have a lot of cash right now, uh, are now optimizing in a way which we can see is through a lot of layoffs. And this is affecting many employees, and it's also in return affecting a lot of culture. What do you think is causing this, even despite having the cash flow in hand?
See, Anjali, any CEO has to be a good CFO at heart, in the sense that he has to keep a vision on the cash flow. The costs are there, the staff is there, the salaries are there, the spends are there. But if the business development team is not getting in the orders and sales, then the cash flow turns red, which means the company will reach a point where it will have to tell potential customers we are about to be broke, potential investors, which also means that the new investors will take their pound of flesh and ask for a discount on valuation. So, to avoid all this, during uncertain times, companies resort to cost cuts across the board. Now, please don't feel I am for recruiting mindlessly during good times and retrenchments during bad times. Money has to come either which way, either from revenue, profit and loss side, or from dilution of shares, the equity financing. So keeping a good 12 to 18 months worth runway cash in bank is a must for a CEO. Now, a CEO company like Byju's, which says that we are retrenching 2,500 people. Uh, People are very fond of Jack Welch, the GE guy who brought greatness to General Electric. He said uh, that always retrench the last performing, the worst performing 10% of your people every year, and always promote the top 20% of your people every year, because 20% of those people are doing all the work and others are just followers. So I think what companies are doing right now is that instead of following this as a practice of building talent in your team, they hire mindlessly during good times and then they tend to fire. So this is the problem. Byju's, for example, had hired, I think, more than 20,000 sales professionals. And if it is throwing out 2,500, it is no surprise.
Absolutely. We always forget to see the complete picture as to where it started and where it is going, right? And it's not only Byju's. There are many other well-funded startups that we see that there is a lot of hiring in the beginning. And then when it comes to allocation and when it comes to seasons like winter funding, you see the first, I think the ask that people face is the layoffs. And we hope that, I think while we are planning to optimize, if we are thinking bootstrapping is a way or we need to maintain cash flows, I think we need to be very mindful when we are hiring as well.
Absolutely. Well said.
So now we've got a little bit of an understanding of what is winter funding and what will be the impact. Let me take a little step back and ask you, what is also the concept behind business valuation and why is it necessary?
Uh, okay. So, uh, how do you value a company? So, companies, they do all this media activities, and so everybody has a vision that, okay, we are talking about this company. I've read about this company, but nobody can make out that, what is the size of the company and what is its value, and how do valuation professionals uh, estimate the value. Let me tell you, valuation is an art, it's not a science. So there are different methods, but end of the day, probably one valuer and the second valuer might throw up a different figure for the company. And uh, and so it is necessary to link the valuation of any company to its financial performance, including turnover, operating profitability, which is the EBITDA, and net profit, assets, dividends, the company issues, and the debt on the books. No two companies are similar because all these factors are differing in different companies. So, valuation runs on multiples of the action happening on the profit and loss side. A company's revenue triples or its operating profitability improves, the valuation of the company will not triple, it will go 5 to 10 times because it's always in multiples. There are different techniques. For example, real estate companies, of course, their assets are their main value. So they are valued on net asset value basis, NAV basis. um, Financial services companies, they don't have any assets, but they have the business from, they take money and then invest that money, so they have a book. So they are also valued on net asset value, and that the value on the books the amount of business they are doing is the asset. Then early stage companies are measured by discounted cash flow, which means that you estimate the cash flows of the company in the future, 5 years and beyond, mostly till the next 5 years, and then we take an assumption of the growth. So we have a sense of the free cash flows available to the company over the next 5 years. Now, depending on which country the company is operating, there is a certain cost of capital associated with that country, the economics in that country. So, by using the cost of capital as a factor, we derive the present value of these future free cash flows. That is discounted cash flow. Then we have multiples which we use, like revenue multiple, like Baiju's. I'm sorry, giving the same example, but its turnover is X and its value is 50x. So the price to revenue multiple is 50. So EV to EBITDA, which means enterprise value divided by operating profitability. And enterprise value means the equity value plus debt. So that is a figure which we get. And the third is price to earnings. So the how much multiple of the profits is the company valued at. So we have all these things, but a wise uh, valuation guy will utilize the methods in such a way that he can estimate a very fair range of the company. For example, if you are estimating it by multiples, then you can see two multiples. One is you can find a similar company like yours which is trading on the stock exchange. Now you know the value of that company on the stock exchange, you know its revenue, you know its operating profitability, you know its net profit. So you have multiples available of that uh, at the valuation at which that company is trading. So uh, you can use those multiples and use it on your profit and loss figures like revenue, operating profitability, and net profit. So you will get that. Second thing is, if you have a similar company like yours in which a funding happened, so you know and you have an idea about what value that funding happened and what is the profit and loss side of this company, so you have multiples from that also. So these are called comparative multiples. And the multiples of stock exchange listed companies is called market multiples. So we can use those multiples as well.
Got it. No, I think this definitely helps a lot, and essentially also to understand what approach will be most applicable for you, what kind of valuation that you need to go for. But I think in general, as you said, right, it all comes down to your cash. It all comes down to your how you are managing your team, how is it optimized, and how much are we looking in the future. Because valuation is more about the present, it's more about the future that the value it will hold. So, thank you, Tushar, for giving such in-depth analysis of the funding evaluations. Now, I would also like to know that what is your take, that what is coming up for the next few months for Indian entrepreneurs?
Well, Indian economy is less prone to external shocks because we are a major consumerist society. Our GDP on purchasing power parity basis is $12 trillion, and on that basis, we are the third largest economy on earth, behind China and US. But we are also home to some really large pool of poorest people on the planet, and on this count, we our indicators are near to Africa. So, in terms of composition of the economy, we are a oil deficit country and have to import 85% of our oil requirements, which requires huge dollops of dollars. So, in 2009, the government at that time had given 20 lakh crore worth of loans from public sector banks, out of which 13 lakh crores did not come back. 65% non performing assets. It took us a decade for the bank's balance sheets to recover, and only now they have begun some lending to infrastructure sector in a meaningful way. So investments have been low in the economy since many years. So any GDP consists of investments, exports, and consumption. We are a Our exports are only, they have risen recently in the last 1 year from $300 billion to $400 billion because of the government's production linked incentive scheme, but they are still very low. investments are low. As I just told you, the banks were totally gone in the last 7 8 years. They have just now recovered. Consumption forms the major part of GDP. So our consumption is strong. So that is why we are not so much affected by what is happening globally, as much as China is affected, being a major exporter, as much as Japan is affected, South Korea is affected. So currently in India, inflation is growing and dollar is strengthening against major global currencies, which means oil imports for us are becoming costly, and which means budget deficit would rise, which means countries' ratings will be under watch. So because of all this, to control the inflation, Reserve Bank of India might increase interest rates, which means money will leave the risky assets like stocks and will move to safe return areas like treasury bonds. So this will cause again some hiccups in the venture capital space, but this downtrend will only be temporary, and very soon, possibly around end of 2023, we should be on track back again.
Great. I think this gives a lot of insights to our listeners that what they should start looking at and what how they should start planning. So thank you again, for that bringing that up. So now coming to that, funding valuation bit, we said that even though how important it is for us to keep a track on it, but despite that, these challenging times and keeping ensuring so many factors together, what processes do every startup need to embrace despite the whatever valuation approach is followed, whatever they should plan for?
Uh, See, the investor will always point towards the existing state of business, and the founder will always say, look at my growth potential. So valuation is an art. There is something called as market making, and market making means that you go out, meet investors, convince them of your value, and then when you have a sufficient pool of investors who believe in your value, then you not only get your valuation, but the liquidity happens in your shares. We call it a liquidity event when the fundraising happens. So what is important is that how valuation is important. See, take some samples of how much stake the unicorn founders hold in their companies. Jeff Bezos, 11% approximately in Amazon. Mark Zuckerberg, 13% in Meta. Falguni Nair of Nika, she holds 52%, 55%, which is way too high when you compare it with others. Vijay Shekhar Sharma holds 14.5% in Paytm. Ritesh Agarwal holds approximately 7% in Oyo. Dipender Goyal holds 5.5% in Zomato. Five founders of Delivery together hold 6 to 7%. So the lesson from this is, if the value of your company is in billions and you are holding 15%, you are still a huge millionaire. But for many Indian entrepreneurs, they believe traditionally in holding 100% equity in their company, and they never look at getting liquidity on their balance sheet side. This is the valuations of today, billions, and then the next round happens 20 times higher price, again the next round happens 10 times higher price. All this media hype, it is forcing the traditional entrepreneurs and the young people who are out from academia, that they want to go on this route, on the venture capital and angel investment route. And this is only possible because of the valuations. And what Don't forget, what happens is, once they a founder becomes quite sufficiently rich, there's a wealth effect, and then he becomes an investor and he starts investing in other companies. And uh, Mr. This free charge guy, the guy who sold free charge, he has invested in 250 companies, and wealth effect spills over. So Elon Musk, the richest guy, he bought Twitter for $44 billion. The second largest buying of a company ever was by Microsoft, which bought LinkedIn for $26 billion, from 44 to 26. Facebook bought WhatsApp for $19 billion, 44, 26, 19. And what is after 19? Straight away, Google bought YouTube for $1.65 billion. So you can see Yahoo bought Tumblr for $1.1 billion. Facebook bought Instagram for $1 billion. News Corp bought MySpace for $580 million. So all these small figures, 500 million, 1 billion, 2 billion, straight away 19 billion WhatsApp, 26 billion LinkedIn, and just a couple of days back, 44 billion for Twitter. So valuation is what enables market making. Valuation it what enables liquidity events. Valuation is what enables the new age style of having funding rounds and growing your company, and that is the whole phenomena.
And shall I say also the base of what we are raising, right? It is the base. Like, if we don't look at it, we cannot really assess the entire process of fundraising.
Absolutely. If you are being very traditional, then you'll end up following the wrong metrics, because I mean, just I give this example in many talks, but it just comes so naturally. I used to look at Udan, and I used to say that these guys are a $1 billion valuation, and their turnover is just 60 crores. And I used to think it's just like what people say about cred nowadays, that
Mhm.
there is hardly any revenue and it is more than 2-3 billion dollars. So these guys used to say that we are locking in the customers and we will start monetizing. So they were able to do it. From 60 crores they went to 1300 crores, 1300 to 5900 crores. They still are losses, I think around 3000 crore losses is there. But that is the way this new age companies tend to think, that make a product very sticky and then you monetize.
True. So I think we've gotten a very big, holistic view as to what winter funding is, business valuation, how we should actually start looking at our businesses from our nascent stages to when we grow round after round. We have gotten a very deep analysis on it. I think as we come closer to this topic, I think this topic can never conclude, right? We can go on and on about this. So I think in the last bit, I would like to ask, which I ask everyone, is that what piece of advice would you like to give to an entrepreneur when they are raising funds?
Well, I will say build a customer centric organization. Customer is the king. Second, sustain to scale, which means build solid unit economics. Then third, don't chase vanity problems. Chase problems which are fundamental to human beings, like metaverse. Somebody putting this and being in a gaming kind of environment, it is not adding value to a human being, right? So that's my view. I'm sorry to say that. So there are climate problems, there are real food problems, there are unemployment problems, there are huge amount of fundamental problems faced by human beings. Always be on day zero mentality. Like Jeff Bezos says, day zero mentality, which is the startup mentality. And lastly, build a lean company to avoid the bureaucracy. Have a lean teams. And just remember, the investor is only looking for three things. He's looking at company's vision and results, he's looking at market opportunity, and the third is the funding ask. I can break up these three things into little smaller pieces, but majorly he's looking at these three things, like company's vision and results, existing business growth, strategy and vision. That's it. If you have that fixed, your company's vision and results are a conviction for the investor. Market opportunity, market size, category tailwinds. Your category, does it have tailwinds? Third, the technology disruption, which is the most critical. And the fourth is competitive differentiation. How are you different from your competitors? This incorporates the market opportunity. And the last is the funding ask, which means unit economics, 3-year growth strategy, application of funds, how will you use the funds, and the last is the management team. So if you have these variables in control, you can convince any investor. This was true 30 years back, this is true today, and this will be true even decades down the line.
Absolutely. You have said it all, that what we all should look at it. And thank you so much, Tushar, for taking out the time and sharing so many meaningful lessons. It was an honor to chat with you. And I'm sure anyone would have a privilege to be mentored by you because you bring so much on the table. So thank you so much once again.